Hello, I'm Roger Peterson. Welcome to Market Call. Stan Wong is on the show. He's portfolio manager at Scotia Wealth Management, and we'll be taking your questions on North American large caps and ETFs. And you can call us toll free, 1-855-326-6266. Send us an email to marketcall@bnnbloomberg.ca. All right, Stan, thank you very much for joining us today.
Thank you, Roger.
We're going to be focusing on the market outlook, and I think everybody's questioning, when does it take a turn? The outlook just seems continually rosy.
We've had a fantastic run since the temper tantrum back in March and April. And I think that there are still conditions that are supporting further upside in the markets. Number one, we're expecting rate cuts in the U.S. We're expecting a rate cut later on this month and likely at the end of the year in December. And we'll see one in Canada this month as well, likely. Tech and AI is still leading the group, but we got to stay selective. Things are getting a bit pricey in some areas. But then, you look at things like seasonality. We've got very, very strong seasonality tailwinds behind us at this point. When you look at Q4, for the last 10 years, it's averaged about a 5.3% return, and it's been positive 9 out of those 10 years in Q4. So we've got good seasonality. And then you look at all the cash on the sidelines in the U.S. We've got about $7.3 trillion U.S. of cash just sitting on the sidelines. And as I chatted about, interest rates might be coming down. Some of that cash is dry powder, might move on into equities and other risk assets, including high-yield bonds and corporate bonds and so forth.
Let's talk first, I guess, about the rates coming down. We'll likely see one or two more. Is there any more room after that, or is that the bottom, do you think?
Right now, the markets are forecasting these 2 rate cuts as highly likely, and then we'll see what happens in terms of data that comes through. It'll be data dependent.
Okay, and then with that money that's sitting there, the what you call the dry powder. That's a lot of dry powder, near record amount, right?
That is a record amount at this point. Of course, not all of that's going to shift into equities and corporate bonds and so forth. I'm suggesting that some of it might move over as interest rates start to fall. Obviously, some of that cash is just allocation, like proper allocation of a portfolio whereby it's meant to be there. But some of that cash might move over to equities and bonds.
Okay, and with all that money floating around, what are we doing with it? Where
Well,
do we go with it?
Our favorite sectors would be financials at this point, and obviously technology has done very well too. That's one of our top sectors. And I like healthcare for its combination of defensive and some growth in there. Specifically in healthcare, there are some areas that have not performed well, such as the big pharmas, and there are some of the names, such as the logistics and the distributors, that have done well. So you got to be selective in that space also.
Now, with the farmers saying they haven't really done well, do you feel they've bottomed, or are we at the bottom with them?
Well, I think they're a bit of a value play, but as you know, with rates coming down, growth continues to be more of the favorite area. So I don't really like some of the value areas necessarily. There are a lot of cheap sectors and industries out there, but in a falling interest rate environment, growth tends to outperform.
And with tech, tech has been the driver this year. Where do you find bargains right now?
Well, I'm not sure if you'll find bargains.
Or deals or something.
Yeah,
something where you're not going to lose.
Yeah, I think you'll find some relative bargains out there. Some of the larger cap names are very expensive, but then some of them are not too bad when you take a look at not just the PE, but you look at the growth in front of it. So some of those names look attractive still at this point, but there are some names on a PEG ratio basis are very expensive. You need to be very selective.
And what are you looking for when you're looking for growth?
Well, we're looking for at least double-digit to teens to maybe 20% earnings growth going forward, and PEG ratios that are below 2 or 1.5.
And now the American market's been going pretty much gangbusters. What do you see for Canada? Do you see the same, not necessarily that amount of money, but is there the same amount of money floating around in Canada?
Probably not, but I do see, obviously, gold has been performing very well. Silver has been performing very well. I prefer silver. It's actually outperformed gold so far this year from a commodity perspective, and banks have recovered very nicely so far this year. But I think when you look at the grand scheme of things, you've got more depth and you've got different companies in the U.S. and you've got certainly more companies that are in the growth area in the U.S. And then you look beyond the North American borders, there's some opportunities out there as well.
Okay, let's talk about that. Where outside of North America?
Well, it's going to be very selective. Like I would say that I have most of our assets are in the U.S. and then some in Canada. and then just a small smidgen in international markets. So it's not really necessarily the region, it's more company specific. So one of the companies that we own would be Mercado Libre, which is a Latin American company. It's kind of the PayPal / Amazon of the Latin American market. So that's one example.
Is that an underappreciated market, and with everything that's going on right now, somewhere like South America?
I would say international markets in general have an opportunity to perform because the US dollar, when you take it relative to the rest of the world, not Canada, has been underperforming. So you'll get the upside of the currencies in international markets. And certainly international markets from a valuation perspective are cheaper than that of the US. There's no doubt about that. US is at high valuations in today's world. However, earnings growth continues to look good in the U.S. If we look at S&P 500 aggregate earnings growth estimate for 2026, we're looking at 12 or 13%, which is very conducive to more market upside.
Okay. Stan, we're going to get ready to take lots of calls. Thanks for joining us today.
Sounds good.
We'll be back with Stan Wong of Scotia Wealth Management, taking your questions on North American large caps and ETFs after the break. We're here with Stan Wong from Scotia Wealth Management. We're going to get right to your calls right now, Stan. Actually, email first, and we're going to start with Daniel and talking about Fortinet, FTNT.
I certainly really like the cybersecurity space. I think that is one of our mega themes long term. Cybersecurity threats will continue to evolve and get bigger. It'll be more costly for governments and organizations and companies to not spend money on cybersecurity than to pay the fines and have the problems that are associated with them. With that being said, a lot of the cybersecurity companies are a bit expensive right now because it's very cyclical. Some companies will say, let's not spend this year and wait until next year. So these companies are highly cyclical and very high beta, so they'll move around quite a bit. I see that Fortinet is now trading below the 200-day moving average. The 200-day moving average is starting to trend down a little bit. So from a technical perspective, I'm a little bit cautious of this particular name. I probably would look at something like CrowdStrike as a larger player, as a preferred name, but I don't think that's necessarily inexpensive as well at this point. Fortinet is trading around 33 times forward earnings, with about an 11% growth rate. So you're paying over 3 times PEG, PE to growth, so not a cheap name necessarily. I just sort of watch it for now, but I do like the cybersecurity space. You look at Fortinet, you look at Palo Alto and CrowdStrike and kind of determine which one makes sense. We don't own any right now. I've been in Palo Alto, I've been in Fortinet, and I've been in CrowdStrike. So we've traded them before, but for the time being, we're out of them. I'm certain that we'll be back into one or more of those names. But for now, I just find that they're a little bit pricey.
Do you keep watching them like on a daily, or do you come back in a month or two?
We take a very active approach to the portfolio. So we watch them on at least a weekly basis and sort of screen for the names and check our radars and check how our names rank relative to the other names out there.
Okay. Let's get more callers in. Michael from Vancouver. Hi, Michael. I think we've... you want to talk about NVIDIA?
Sure,
absolutely. Just a quick little...
Yeah, so NVIDIA is a name in our portfolio. It's one of our top
probably
tech
everybody's
names.
Portfolio, it feels like right now.
I would hope so. That'd be good for portfolios. And it just hit a brand new 52-week high today, and I think that's an all-time high as well. I think that NVIDIA really is the heartbeat of the artificial intelligence space. It's got a lot of runway for growth. Yes, you are paying 34 times forward earnings, but we're looking at about a 35 to 40% growth rate. So, back to the top of the show, what names are cheap? From a PE to a growth perspective, on a relative sense, NVIDIA is not expensive. And in fact, it's probably cheaper than it was many years ago. So I think that NVIDIA, so long as the earnings continues to roll in, is a name that investors should own as part of their tech space.
What would be a number that you might have you rethinking it?
In terms of a PEG ratio,
Yeah.
Well, I think the PE to growth, you start getting to 2.5 or 3, we start rethinking some of these names. There are lots of names out there that are a bit expensive. I know that they're popular. Palantir is relatively expensive. When I sort of screen it, I think that PEG ratio is right up there. I'm pretty sure it's well above 3 or 4 at this point. So, not the same space, of course, but to give you an example of another tech name that's a bit pricier for me.
Okay, let's get back to the calls. And Walter from Kingston.
Stan, thank you for taking my call. It's on Visa. I noticed it hasn't kept up to the S&P 500 in the last several months. And I don't know why, because it's a very strong fintech company. It's instituted a $20 billion share buyback. I'm just thinking, is it out of favor because all the money is going into high tech? Will there be a rotation back, or is there something else going on? And also, do you prefer Visa over MasterCard? Thank you.
Sure. Thanks for that question, Walter. We actually own both Visa and MasterCard. I like the long-term secular growth of both these names. We see still half the world or half the transactions in the world still being cash. And more so, obviously, it would be more digital payments. So we see that growth continuing in that space. Shorter term, we're seeing more cross-border transactions after the pandemic. We're seeing more travel in the leisure sense. So I think that Visa and MasterCard will continue to benefit in those spaces. And I do like companies that are sitting in industries in which there are a few competitors, and Visa and MasterCard is a great example of that. Yes, the Visa has underperformed the S&P 500 since about April, but it's still been performing okay. Much of that is the fact that 40% of the S&P 500 is tech or tech-oriented names. But Visa's been up 27% in the last 12 months, so not a bad return there. You're always going to pay a bit of a premium for names like Visa and MasterCard. You're paying about 28 times for Visa, but you've got about a 13 to 15% growth rate ahead of it. So I continue to like Visa, and I do own MasterCard as well.
And just going back, you mentioned about more than 50% using Visa or credit cards all the time. What's it been like since the pandemic? Because we talked about everybody saying, oh, we're going to a cashless society. Has that trend continued, or did it back off?
It's continued to move towards digital payments. I mean, you think about shopping these days. Most of our shopping is online, at least for me it is. I'd rather sit at home, buy what I need, and wait for the delivery the next day or two. And I think that's growing. And then, in international and emerging markets, it's moving slowly or gradually from cash into online or digital payments as well. So I think that runway for growth for names like Visa and MasterCard is still very strong.
Okay. We're going to be back with Stan from Scotia Wealth Management taking your questions on North American large caps and ETFs after the break. Stan Wong joins us now to talk more to our callers, and our first caller is Chris from Victoria. Chris, what's your question?
Oh, good morning, Roger. Good morning, Stan. Roger, when I hear your voice, I keep thinking of that real estate show, and that it's the weekend in Victoria, and it's still throwing me for a loop after a few years of market call. At any rate, great to see you on the show.
Cheers.
And Stan, if I could please have your opinion on the luxury goods space as a whole. I believe you've been in and out of both of these names, LVMH and Hermes. Just curious what you think about them as a long-term hold. I'm a 29-year-old investor, so lots of time if I buy it at the wrong time to recover it. Just appreciate your thoughts. Thank you so much.
Thanks for the call. So previously, I've owned LVMH, and I've owned Kering Company, which is the parent company for Gucci. We are out of those names at this point. It's been a tough and challenging go for a lot of luxury names since the pandemic. There has not been that recovery in Asia and China, specifically as we had thought. So a lot of those names have been not doing very well. Hermes has been not bad, and however, like 200-day moving average is still rising higher. However, it has recently dropped below the 200-day moving average. So for me, from a technical perspective, that's something that I keep an eye on. That makes me feel cautious. I do note that in July, there was a Hermes original Birkin bag that sold for $10 million at an auction. So I just saw this story on my Bloomberg. So that's interesting. With that being said, I mean, I think that a lot of these names...
Your wife is going to be so surprised when she gets it.
I'm not going to mention that to her unless she's watching the show now. So I think from the luxury brand perspective, long-term, I think it makes a lot of sense because there's growing wealth, especially in areas like Asia and so forth. But for now, I think cyclically they're put in the back burner somewhat. The only name that has performed decently, and some will argue, well, that's not really a luxury name, is Tapestry, the parent company for Kate Spade and Coach. That stock's done very, very well, but it could be because it's more, mid-price rather than luxury price. So Tapestry is a name that's done well. I don't own any of the names in these particular spaces today.
I'm just thinking of Coach not being a luxury.
Yeah.
I know I can't afford any of them. Okay, let's get back to the phones. And John from London.
Oh.
Hi, John.
Over 7.3 trillion of uninvested capital in the U.S. That's 13% of the S&P 500 market cap. And if you divide that by 350 million people in the U.S., that's $2 million for every man, woman, and child in the U.S., if you can believe that. Stan, my question's on Uber. I know that Lyft has had some press recently. I think you're an Uber fan. I own Uber. It's sort of heading upwards. I thought maybe faster. It's more of a technology company than it is a Lyft company. What do you think of Uber? Maybe an ad, maybe a 2 to 3 year hold. Thank you very much.
I don't own Uber. I've actually never owned Uber. We'll talk about a name that's somewhat related in the top pick segment, somewhat related to Uber, but not exactly. From a technical perspective, Uber is doing fine. It's moving higher. The 200-day moving average is also lifting higher. However, I kind of worry about some of the competition that's down the road, and specifically autonomous vehicles that are coming, such as Waymo and so forth. Of course, they're diversified. They're not only in ride sharing, but they're also in delivering of foods and groceries and so forth. But I do note that earnings growth for the next few years seems to be somewhat muted at this point. So when you're paying 30 times for a stock, you want to have some very good earnings growth ahead of it. We don't see that, or I don't see that right here, at least for the next few years. I think taking into this year, there looks to be an earnings decline in terms of negative growth. And then going into 2026 fiscal year and so forth, it might pick up a little bit. Regardless, you're paying about 30 times. You might get back to 15% earnings growth. Then you're paying 2 times PEG ratio, which is not bad, but not really exciting either.
Enough for you to catch another ride.
Exactly. Very good.
Okay. Let's get some more calls in here. Justin from Coburg.
Hi, gentlemen. Thanks for taking my call. Stan, I was hoping I could get your thoughts on AMD for a long-term hold. And just a part B to my question, knowing that the semiconductor industry is cyclical, do you find that this is a sticky business? So, for example, if the mega scalers are all buying NVIDIA chips or AMD chips, is it easy for them to switch from one to another, or do they kind of get pegged to the company they're purchasing the chips from? I'll hang up now and listen to your answer. Thank you.
Okay.
Thanks for that question. Certainly AMD has taken off with the OpenAI deal. We own NVIDIA instead of AMD. AMD's had a very challenging couple of years, and recently it started taking off. Again, mostly because of this deal. You're paying 46 times forward earnings for about a 30% growth rate, and that growth rate has really taken off. More of late, a lot of analysts have raised their estimates. But as you would look at the chart, I mean, that 200-day moving average has been falling and only started to lift up because of this recent sort of surge in the stock. To answer the question about how sticky supply chain is, relatively speaking, they are fairly sticky. But of course, when new technologies emerge and there's regulations that come about, it can be unsticky at those times. But by the most part, a lot of these supply chains are very, very sticky. It takes a lot to sort of change, who your suppliers and who your customers are. Taiwan Semi is AMD's largest supplier, and Sony and Avnet and HP are its biggest customers. So I would prefer NVIDIA. I actually think NVIDIA is still cheaper than AMD despite the move in prices for NVIDIA. So I like NVIDIA more, and that's what we own.
Okay. On that note, we're going to take another break, Stan, but we'll be back and we'll take a look at Stan's past picks at that point. And time now for Stan's past picks. And Stan, we're going to start off first with a nice one here for you, Caterpillar.
Yes, so we sold out of Caterpillar. I had bought that during the, added to it during the market sort of downturn in March, but held it from last year. Just sort of felt that it was getting a bit pricey at around 27 times forward earnings with about a 6-7% growth rate. So it was trading at a premium to historical prices. So I just saw the opportunity to take a nice profit there, which we did, and we moved on to some other names.
All right. Is there anything outside of those numbers that you were talking about that kind of helps you make a decision, or is it?
Yeah, for that one is really valuation, and we had a really nice profit in that particular name. Obviously, it's very, very cyclical as well, and because it's cyclical, it's going to move around. So there'll be another opportunity to buy a name like Caterpillar or Deere or something along those lines. All those industrial, heavy machinery type of names. Yeah. They'll move based on news. They'll move based on what China announces and so forth. So there's always opportunities to roll back into them during a bit of softness in the market.
Okay. Netflix. It's a classic now, isn't it?
Continue to hold it. I mean, you're paying 40 times forward earnings. However, you're getting about a 25+% earnings growth rate forecasted. There are over 300 million global subscribers today across 190 countries. Obviously, the opportunity is the international markets, and they're just continuing to come out with these Netflix hits and these original film series and live events. Their deal with the WWE, getting into football for Christmas Day. The Mike Tyson fight not that long ago.
I don't know if it was a fight or not, but anyways.
Yeah, I would agree with that. But getting these great global hits and also getting very localized content across the regions is really lifting Netflix to where they are today. I mean, when you look at 5 years ago, like who was going to be the streaming winner? Was it Netflix? Was it Disney Plus? Was it HBO? I think it's pretty clear today that Netflix is the streaming giant.
It really does come back and surprise people time and time again, doesn't it?
It does, considering that they went from selling DVDs through a vending machine at grocery stores.
It's incredible. Okay, the last one, iShares Core.
We continue to hold this. It's important to diversify away from just the S&P 500. As I mentioned, the S&P 500 is highly in technology and tech-oriented stocks, about 40%. Long-term, mid-caps do outperform large caps, namely the S&P 500. You go back 25 years, mid-caps have actually outperformed the S&P 500. They tend to be a bit more leveraged to U.S. economic growth. So as long as we see a runway for economic growth in the U.S., mid-caps can perform well. But of course, a lot of focus and a lot of the excitement today is around AI and semiconductors and so forth. I've been doing this for a long time. That's only going to last for so long. And not to say that we're going to see a big downturn in that space, but other sectors will start to perform as well. And with this, you get into 400 mid-cap names, the S&P 400, for only 5 basis points. So it's a good way to diversify your portfolio away from all the mega cap names out there.
Okay, a good return, but there's a little more risk though too, right?
I'm not sure about that. So when you look at actually the volatility of mid caps over time, it actually has not been as necessarily riskier than the S&P 500. So you kind of get better valuation, not that much more risk, and historically a better return.
Yeah, because they always seem to have not a bad name, but compared to the.
I would say, and that's why we're not in the small cap ETF space. I prefer the mid caps. There are names in there which you'll recognize. Obviously, some names that we won't recognize, but the mid cap companies are not tiny, especially when you look at the U.S. today.
Yeah, no, it's a relative number, isn't it?
Exactly.
I mean, what's a mid? Is it 500 mid?
I don't know. I don't recall the exact number. I always get tripped up with that one.
Yeah. Didn't want to put you on the spot.
Yeah.
But so they're working. They're worth looking into.
Yeah, it just diffuses the portfolio a little bit. Instead of having everything in the Mag 7 and a few other names, have some diversification, own some names like Williams Sonoma, et cetera, through an ETF like this.
And what do you look for when you're looking at the big caps? Like what's a good trigger for you?
Again,
is it the companies?
No different from what I'm looking for with large caps. I'm looking for companies in limited competition industries, and I'm looking for companies with outsized earnings growth. Earnings growth is what really determines forward returns over the next 1 to 3 years. not necessarily valuations. I mean, you could look at valuations, and there are some years when things are very cheap, but the one-year return is very bad for that market or for that stock or index. And sometimes valuation is very expensive, which we're kind of looking at right now, but the markets are doing well. So valuations are not a great predictor of forward returns, especially over short term.
Okay. We'll be back with Stan Wong of Scotia Wealth Management, taking more of your questions on North American large caps and ETFs and some maybe as well. And let's get back to your calls with Stan Wong and David from Scarborough, Ontario. What's your question?
Thanks for taking my call. Stan, Eli Lilly and Novo Nordisk, which do you prefer? Do you own any of them? Thanks.
Thanks for the question. So we previously owned both Eli Lilly and Novo Nordisk, but we've sold out of Novo Nordisk. Novo Nordisk is a little bit more concentrated in the diabetes and weight loss space because of competition, because of generics. That weight loss space has come out of favor somewhat. I prefer a name like Eli Lilly because it's not just in the diabetes and weight loss space. It's in obviously other areas, including oncology and so forth. You'll notice from the chart, Eli Lilly has performed a little bit better. The technical structure is better because the price for Eli Lilly is above the 200-day moving average, whereas for Novo Nordisk, you've got a falling 200-day moving average and a falling price below that. So that's something that concerns me on Novo Nordisk. I think long-term earnings growth will come back, and I think it'll come back into favor because it is a big market, the weight loss and diabetes market. That's not going away. But for the time being, I think some of the cyclical things are hurting names like Novo Nordisk. And for me, I prefer Eli Lilly. Okay. Not necessarily that it's performed very well. It's kind of really been flat over the last 12 months or so. It's flat to somewhat negative, but it has performed better than Novo Nordisk. And I think it's largely because it's at a larger scale. It's a bit more diversified as well. And as a result of that, it's a bit more cushioned. And we actually see much better earnings growth from Eli Lilly. We're looking at 15% earnings growth, whereas Novo Nordisk is down to about 6% today. Okay.
All right, let's get some more calls in. And Roger from Hamilton, Ontario, what's your question?
Hi, Stan. Great to see you on the show again. I recently bought CGMU for like a short-term hold, but it's the best-performing ETF this quarter. It is Canadian gold miners. I'm just wondering on your view in the gold mining space and if I should buy more.
Yeah, tough questions, but certainly gold has been a phenomenal performer so far this year. I will say that for our portfolios, we own silver, which not many people know.
But it's done almost as well, right?
It has done better than gold so far this year. It's actually performed better than gold. And for me, I think with the historical ratio, average ratio price between gold and silver, it's extended right now. So either gold's got to come down fast or silver's got to go up or a combination of the two. Nonetheless, I think silver has a better path going forward. I note that silver is up about 71% this year and gold's up about 52%. Look, we're not going to be complaining about a 52% return, but silver's done a bit better. Yeah. XGD would be your large cap gold miner name. That's the one I know well. We don't own XGD, but that will give you the Barracks and those types of names in there. To answer the question of should you own more, difficult to say. Depends on how much you own. If you own 30%, I'd say no, you shouldn't add to that position. If you own 3%, yeah, you can add a few more percentage points. With that being said, I mean, gold at the end of the day is a very highly cyclical space, and we've had many cold winters, and I mean years of gold performing poorly or not doing anything, and it wasn't that long ago. So all I would say is I wouldn't want anybody to necessarily overload on any particular commodity. Yeah. They go through cycles. Oil does it, gold does it, silver will do it. They all will. So, we've got a really bright light with gold right now and a lot of attention to it, which worries me a little bit when too many people are interested in one particular asset class or space. But for the time being, the momentum is there. But I would say like gold right now, the commodity is very overbought. It's showing a 77 RSI, relative strength index, which indicates overbought, at least near term.
Okay. Let's get some more calls. And I know we've got a lot of people who want to hear from you. Nicole from Montreal.
Well, hi, guys. Stan, good to see you. I just wanted to ask you about the former investor favorite, Cisco, if you think it will return to its glory days. Thanks. Have a good day.
Thanks for the call. So the stock has actually been performing decently. Technical structure looks okay. Its price is above the 200-day moving average, which itself is moving higher as well. With that being said, when you look at the tech space, you're generally speaking, you want to see 10, 15, 20% earnings growth companies. Cisco is an 8% earnings growth company with a 17 times forward earnings. So it's not necessarily pricey, but it's not really cheap. But for me, I'd rather find companies in the tech space that are growing like a Netflix or an Amazon and so forth. So at 8% growth rate, that's okay for other, more mature industries. And I guess Cisco is a mature company.
Mm-hmm. Yeah.
But for a tech name, I think you'd rather own like an NVIDIA and again, Amazon and so forth. Technically, it looks okay. It seems to be performing decently. But for me, if I were to choose between a Cisco and a faster growing tech name, I'd choose the faster growing tech name.
Okay. Going to head back to the phones. And Stanley, you're calling from Kingston, Ontario. What's your question?
Hi, my question's on the most important company in the world, Taiwan Semiconductor. It's had a good run. Would you buy it at this price? Thank you.
TSM has performed very well. It's up 62% in the last 12 months, and it's in a very important part of the AI infrastructure and the semiconductor space. Obviously, it's growing at, or expected to grow at 25% earnings growth rate, and you're only paying 29 times forward earnings. The only bad thing about Taiwan Semiconductor is that I don't own it in my portfolio. And we want to own it, but we just haven't had that opportunity. We were looking for a pullback, and we haven't had that sizable pullback. So I do like this name. Of course, there's some geographic, regulatory issues that you want to be careful of, considering where this company is headquartered. But it's a name that makes sense as part of your tech space. And I do like that name.
Okay. On that note, reminder, we'll be back with Stan Wong of Scotia Wealth Management, taking your questions on North American large caps and ETFs after the break. Stan Wong is with us, and joining us now is Bruce from Simcoe, Ontario. Bruce, what's your question for Stan?
My question will be on Berkshire and Warren Buffett's cash position. I guess he's very cautious right now on the market.
He is. All right, Bruce, thank you for that.
We don't own Berkshire in our portfolios. I mean, certainly it's performed extremely well, but I think that the key thing is that Warren Buffett will be stepping down eventually, and that's going to change the nature of this company and how it's run and so forth. You'll notice that, once he made that announcement, the stock price had started falling, and it has recovered a little bit. And the other thing to remember is that a lot of the company, more so before until he unloaded some of Apple, much of it's based on Apple. It's a big percentage of the portfolio, and then there's American Express and Bank of America. And a lot of these names make sense, and I do like some of these names, but they are value names, not the Apple. I mean, it's more of a growth name, although some would argue that there's a bit more value in there. And some of these names are more value-oriented type of names, and that's why some people will compare Berkshire to the growth index, the S&P growth index, and that would have performed much better. And again, in a falling interest rate or a low interest rate environment, growth stocks will perform. There's a lot of excitement about the new frontier with regards to artificial intelligence. You're not going to find much of that in Berkshire Hathaway. So not to say that Berkshire Hathaway doesn't have a place in your portfolio, but it depends on what you're looking for. If you're looking for a name that has lower valuation type of companies, Berkshire can do that for you. But again, I think the big overhang is the fact that Warren Buffett's going to be stepping down.
And so there's going to be a little instability until they see which path they're going on. Okay, let's get to an email, and this one is from Gus. CTC, your thoughts, please.
Yeah, so Canadian Tire is a well-diversified Canadian retailer. They've got Marks, they've got Canadian Tire, of course, and Sport Chek. And the stock has done relatively well over the years. The 200-day moving average continues to push higher. The stock price is above that. It's actually fallen down to that area more recently on a miss for Q2. So they did have an earnings miss in Q2. So that's why the stock has fallen a little bit. The only caution I would say is, how healthy is the Canadian consumer? How healthy is the Canadian economy? Unemployment now is above 7% in Canada. We've got a lot of competition in the retail space from e-commerce competitors and discount retailers that are in Canada. So some of those things make me cautious about a retailer in Canada. The name that I like as a retailer, very different from Canadian Tire, is Dollarama. Low-cost retailer. Just given the sign of times, inflation's really, it's low now, but it's cumulatively since the pandemic has really shot up.
Yeah.
So, we like Dollarama as a retailer name relative to the name like Canadian Tire.
Okay. Let's get back to the phones. And Nizar from Scarborough, Ontario, what's your question?
Oh, hi, Roger. Hi, Stan. May I have your thoughts on Manulife Financial, please? It seems to be range-bound between $42 and $45. Could it fall back to 42 or 40 with the correction in October, notwithstanding the fact that September was positive for TSX? I recall you hold Manulife Financial. And if you have the time, would you prefer insurance companies or banks? Thanks for taking my call.
All right. Cheers, Nizar.
So Manulife was a name that we held in our portfolio. We took profits in it not too long ago. Exactly the reason why the caller was mentioning is that the stock has been very range bound over the last 12 months plus. The one nice thing about Manulife is that you're getting about a 3.9% dividend yield, which we expect to grow over time. Fundamentally, they're in the right spots. They're demographically, aging demographics will help the the asset management side of Manulife. So I like it longer term, but right now we're out of it. We've made our money. We still continue to own Sun Life. And the last question is banks versus life insurers. You want to own both, I think. You want to own the best banks out there, and you want to own the best life insurers out there. But don't forget about the U.S. banks, because there's a lot of leverage for some of these U.S. banks. If you look at a name like J.P. Morgan, which is in our portfolio, that name has done very, very well on the back of a strengthening U.S. economy, on the back of deregulation in the U.S., and just very strong management.
Okay. We get one more email in, and it's from Ray. Could I please have your thoughts on Carnival Cruise Line, CCL?
The cruise lines have performed very, very well. As you recall, during the pandemic, they really got decimated. I don't own any cruise lines today, but I did purchase Royal Caribbean back then because it just got beaten up so much, and we took advantage and sold it. Generally speaking, Carnival has a very good growth rate ahead of it, as does most of the other cruise lines. With Carnival, we're looking at about a 20% growth rate ahead of it. And from a valuation perspective, it's kind of like fair at this point relative to history. There is travel recovery. The only thing about cruise lines that make me cautious for longer periods of holds is you've got heavy leverage, you've got relatively larger debt loads, and you've got very strong economic sensitivity. So when you're in the travel space, and we'll talk about a travel name later on, I'd rather a name that has very low capital expenditures, less debt, and just not really dependent on such a strong economy. Because cruises, generally speaking, you need a pretty strong consumer and economy. And of course, labor and fuel costs kind of factor in as headwinds as well. So to recap, technically the stock is doing okay, but I think there are other travel names in a slightly different space to consider.
Okay, we're going to talk about that coming up after the break. That's all the time we have for calls for today, but don't go away, Stan. We'll share his top picks. That's next. Tomorrow on Market Call, Hap Sneddon will be on the show. He is President and Chief Portfolio Manager at Castlemore, and we'll be taking your questions on technical analysis. All right, time now for Stan's top picks. And first up, a regular name. A lot of people recognize this one, DoorDash.
Yeah, DoorDash is a great name. We like this. It's really in the theme of convenience and sort of last mile logistics that is evolving and growing in the United States and around the world. I mean, DoorDash controls about 65% of the U.S. food delivery market, and they're evolving into a broader commerce platform. They're moving beyond restaurants. They're going to groceries, convenience, retail delivery. I still hear the DoorDash commercials in my head. And with this Dash Pass loyalty program, that just continues to drive loyalty and higher order frequency. You know, you're paying a fee for this pass, and you're going to use it more and more often. And margins are improving, profitability is improving, using AI to improve sort of order flow and so forth. That's helping them as well. In 2026 fiscal, they're expected to earn about $16 billion in revenues, US dollar revenues. And earnings growth is very strong at about 30 to 35% expected going forward. So this is a name that is one of these evolving themes. Again, convenience and last mile logistics. And more people want things to be more convenient. They want things to come to them. They don't want to, go 2 blocks down to go to the restaurant to pick up
Ask my 18-year-old son about that.
Exactly.
Any concerns, though? Like Uber's already there with where they're trying to branch into. Is the market crowded or is there room?
Certainly.
And you've got places like Walmart doing deliveries and things like that.
Yes, certainly competition, but I think being that leader is a big thing. I think that allows them to continue to be in that leadership space and be able to spend money on infrastructure and AI to continue to evolve. And because the market is expanding, it's not a static market, there's room for everybody to grow.
Okay. Let's talk travel. Expedia.
Yeah, so a name that I was alluding to earlier, so Expedia is a global travel powerhouse next to Booking, which used to be called Priceline.com. So they own, obviously, Expedia.com, they own Hotels.com. So these are some of the biggest brands, like Vrbo is part of Expedia, Hotwire, Orbitz. They own a majority stake in Trivago. And in 2026, we expect about US $15 billion in revenues. Bookings are continue to be very, very steady. There's growth there. There's rising margins. There's very, very solid free cash flow compared to what we were talking about, cruise lines. They don't need to worry about, fixing ships and capital expenditures. They don't need to worry about fuel costs and so forth. They've got a very strong One Key loyalty program, which is boosting their engagement and boosting loyalty and more travel. They're using AI to target what makes sense for a traveler and using those analytics to provide dynamic pricing, which increases margins. And if you look at long-term trends today, we not only have aging demographics, which want to travel, but we also have this hybrid remote work flexibility that we have today that we didn't before the pandemic. And that allows people to say, I'm going to work from
wherever,
the islands or Bahamas or whatnot. So that allows for that experience-driven type of spending for young people and aging demographics to take advantage of travel trends out there. Business travel has not picked up to where it was before the pandemic, but certainly leisure travel has exploded. And we see about 18% earnings growth for this company going forward.
Okay, let's get the last one in. People might have heard of this one, Meta Platforms.
Yeah, it's, some people might have heard of Meta Platforms. So, this is a social media giant, as you know, Facebook, Instagram, WhatsApp, and Messenger, 3 billion users around the world. We're looking at $227 US billion fiscal 2026 revenue. So this is the serious giant out there. And this is one of the mega cap tech names that is not that expensive. We see ad demand continue to grow. They're using AI to target market their users as well. So profitability is improving as well. They're enhancing their ad performance by using artificial intelligence. And they're personalizing content to the users and Instagram and so forth. So that's improving user engagement as well. So they've got very scalable technology, and they're expected to have earnings growth of over 17%, and cash flow continues to be very, very strong for a name like Meta.
And any concerns that they can become stagnant, or they're always looking? It always feels like they're slightly reinventing themselves all the time.
Well, Facebook seemed to be something that was getting more stagnant, but then Instagram is the new thing. Well, it's not so new anymore, and that's very popular. And there's still a runway to monetize WhatsApp, which they haven't really used directly at this point. So I think there's a major opportunity with regards to their virtual reality. That hasn't really been a big winner for them just yet, but that could be the future. And getting to that artificial intelligence space is very important for a name like Meta. I almost said Facebook, but Meta platforms.
All right, almost out of time. Anything you're, actually, you know what, I won't ask. I was going to anything you're keeping an eye on within Meta, but any concerns? And you got about 10 seconds.
Yeah, I just think that it's a great growth company, and it's one of the cheaper mega cap tech names.
Okay, we're going to leave it on that note. Stan, thank you very much for joining us.
Thank you.
Stan Wong is a portfolio manager at Scotia Wealth Management. Thank you for joining us. And thank you for watching Market Call. We'll see you tomorrow.